Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, as always, we have with us our CEO, Dhirendra Kumar, and he will help us unveil some of the critical do's and don'ts for successful investing. Dhirendra, you often say that while, the list of do's is not as big, it is actually the don'ts one needs to, be careful about while to be a successful investor. So let's start with the don'ts then. What are the three big red flags that one must consider, before starting to invest?
What is to be not done? There are plenty of it, but I will actually highlight the prominent ones. Most people think that, stock market is a game and you have to trade. And trading is a quick way. The saying is that a fool and his money soon part ways. And trading is a quick way of doing it, because many people think that, if you trade your way into the market, or if you are able to figure out, then, money just is made by buying something, selling something. Not really. It's a very difficult thing. The cost of transaction, your ability to figure out something. What works in investing is not trading. What works in investing is buying a great company, holding it through ups and downs, and holding that through ups and downs is possible only when you have the understanding that, okay, what is the promise and how long will it take, and so developing a belief about that company. Trading doesn't get you any of those. So you just incur cost while trading. Next comes, most people think that, trading is a quick way to make money, and market helps you do that. Derivatives, it is often being referred as, weapon of mass wealth destruction. That is, it's like a leverage trade. When you invest, when you buy derivatives, it helps you ride a position which is sometimes 10 times bigger, 20 times bigger. And in a rising market, or when your betting gets right, what happens is by putting 5 rupees, you are able to ride a trade on 100 rupees ownership. So if 100 rupee becomes 105 rupee, it feels like you invested 5 rupee and now you have a gain of 5 rupee, which is 100% gain. But the reverse also works just as true. Reverse, what happens is you put 5 rupee or 10 rupee and you are riding a trade of 100 rupee, and 100 rupee becomes 90. Your 10 rupee becomes 0, because now if you square up your transaction, your 10 rupee is gone. So understand this, a leverage trade works both ways, and that is what derivatives trading is.
So no trading, no derivatives.
No
What
derivatives.
is the third red flag?
Third one is, it's not that big a red flag, but mostly what happens is people think that investing in an IPO is a quick way to make money. And yes, you do, but it generally doesn't work out that way. What happens is a good company, if a company is good, then that more people will be wanting that IPO. Then your betting average will go wrong, because there is an element of lottery in every IPO. A good company's IPO everybody wants, so the number of times oversubscribed is far higher. A bad company, and if it turns out to be a very large base, if you recall, IPO of Paytm, it was a huge issue. Many people wanted it, many people invested in that, but it was so big that everybody got allotted. And everybody got allotted, and the price actually tanked on listing. So if the company is good, it will be in huge demand, and your likelihood of getting allotments will be lower. If the company is bad, not too many people will turn up, and you are likely to get allotted there, it will not multiply. Third is that, here is a company which is going public for the first time, and the information, disadvantage that you have, here is a promoter. And normally what is happening nowadays, that the company is not raising money from investors directly. Somebody has bought the issue, somebody has invested in the company, and now this person is selling his shares, which was bought at a lower price. Somebody has borne the risk and waited for a long period of time. If you look at, and they are called offer for sale, that is an IPO. And most of the IPOs nowadays is offer for sale. So somebody has bought the shares of a company, held it for a couple of years, took all the risk, and now the company has scaled up, and now they're going public. And he's going to liquefy his holdings. So are you getting it cheap? Here is a guy who has taken all the risk and trying to hog that shares in a favorable market when people are queuing up to buy it. So normally, you're on the other side and you are at a disadvantageous side. Even before that, there is one motherhood statement which I would like to give, which is the biggest red flag. And I have come across, it's a very funny situation mostly. Sometimes, people so easily fall for something which is too good to be true. It is, you will come across a proposal that, somebody was told something and the money will multiply as if some magic is happening, and he will come across some reference. And it will normally be people in your own circle, and it will be, it will be an illegal transaction. It will be, it will not be a legitimate thing. But people fall for it so often. So the ground rule is very basic. Something which is too good to be true is very likely not true. And you have to really, you have to look at every such thing with great suspicion and doubt. Your default should be that this is all a lie. And then it has to prove itself otherwise. And unless it has been getting proven conclusively, don't fall for it.
All right. That's the don'ts that we've spoken about.
That's the first one, which everybody should.
Right. Now let's move on to the do's. Where should one start?
A few do's, because one is that first and foremost, to be able to do something, you need to spend little less than what you earn. Because if you don't save, nothing starts. You can't borrow money from your parents and, invest, because that's a borrowing. So one is that fall in the habit of saving, because saving is not a matter of earning, how much you earn and how much you spend. Of course, it is at a very fundamental level. But your ability to save is entirely a matter of habit. If you don't fall in that habit, any amount of earning will not take you anywhere. So that's one. Second is that think long term. Saving is not enough. Putting your savings to work, which is you have to make investment. Whether to make investment, don't wait for that, till you are able to figure out, you are unsure. If you don't know what to do your recurring deposit. You will be assured. Go to a post office and do it. If you don't have access to the market, you can't learn anything as of now, you're busy. Do your SIP, your SIP in a bank, that is the recurring deposit, or in a post office. Then comes, long-term money, do your mutual fund SIP. Third is that, most of the time we are thinking in terms of a constant, that, okay, I save 5,000 rupee, I save 500 rupee, I save 1,000 rupee. It is important to, increase it, because inflation is going up, your income is going up. And if you don't increase your annual saving, increase your rate of savings. If you are saving 10% of your income today, make sure that it remains 10%. If you do this, follow this basic rule, you will end up with something sizable, And you will also understand or appreciate the value of, develop an understanding of compounding and the magic of compounding.
All right, then. These were the do's and don'ts that you need to be careful about. Now, here's a viewer's question. Dhirendra Nishit has accumulated a portfolio which comprises mutual funds and stocks recommended by Value Research, he says, of about 1.05 crore, which includes almost 90% equity. Now, at the same time, he has a housing loan of about 1.32 crores on an under-constructed apartment at the rate of interest of 8.5%. So he has a PF of 35 lakhs and NPS accumulation stands at 15 lakh. He wants to know your opinion on whether to prepay the loan and reduce it, or, invest.
Yeah, I'll just give him a framework, because, I don't have an answer, because I don't have all other additional information about his context. But one is that, he has a 1.5 crore rupee accumulation. If you take into account 1.05 crore, which is the investment value, 35 lakh rupees is PF, 15 lakh rupee NPS. So he has 1 crore 55 lakh rupees as his investments, sum total of everything today, and not all of it will be taxable. His equity investment might be taxed. A part of the gains will be taxed at 10%, 15%. So he'll end up with little less. Likewise, all his PF may not be accessible, and all his NPS accumulation will not be accessible. But assuming that he has borrowed money, and his borrowing is 1.32 crore. He has a couple of problems. One is that the borrowing is large, but this borrowing is large or small, he can only judge, Because one is that he should be realistic about his borrowing and the repayment capability. If the repayment of this 1.32 crore is 15%, 20%, 25%, or 30% of his total income, it is fine. But then there is another problem. If he is spending money on rent today, and he's paying the EMI as well, this is additional. So he should work to, he should make sure that he gets the money in time, he gets the house in time, so that he starts saving on the rent.
Right.
That will be he should aspire for, or he should try and look for if that can be speeded up at all. Second is that so being prudent with your borrowing and the repayment, that is one thing which he has to decide. Second is that having a long-term loan, most housing loans can be long-term, 10 year, 15 year, 20 year. If that is the case, and 8.5%, this is the only loan which I encourage people to carry on. Of course, in a prudent way. Make sure that it is not, it's 80% of your income if goes into repayment, then you are in difficulty. Because your house is not a speculative investment. Your appreciation of the value of the house does not translate into an income for you. You can feel happy that, okay, you bought it for 1.35 crore and now it is worth 2.5 crore, but it does not translate into any cash inflow.
If you're living in it.
If you are living in it. And the whole idea should be to live in it and to be able to save on rent. So I would say that get the house, make sure it is not substantially more than, it's not a sizable part of your outflow, of your income. And third is that carry on with this. If you are able to follow this framework, then carry on with your home loan. The long-term return on your equity portfolio, which is substantially equity, and even NPS, which could well be up to 75% into equity, that can well generate. And your provident fund is generating as much return as you are incurring, or close to that much return as you are spending on by way of interest on your home loan.
All right, then hope Nishit, that answers your query. Now that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.